Hi, I'm John Persinos, Editorial Director of Investing Daily, with a video presentation for Monday, June 12th. To view our full range of trading services and publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. We've enjoyed a strong rally so far this year. The tech-heavy NASDAQ officially exited the bear market in early May. The S&P 500 passed that threshold last week. Despite bullish conditions this year, many analysts have been consistently warning that the next shoe is about to drop. That hasn't happened yet. Not even the banking crisis in March could derail the market's rise. Wall Street has been climbing a wall of worry all year. The worst fears haven't materialized. The U.S. and other economies overseas have defied pessimistic expectations and posted surprisingly resilient growth, regardless of central bank tightening. The S&P 500 last Thursday finally cleared the closing demarcation that marked a 20% rise from its October 2022 low, meeting the technical criteria for exiting a bear market. The index extended those gains on Friday. If history is any guide, we can now look forward to big gains in the months ahead. Take a look at the following chart. During the first 8 months of a new bull market going back to 1932, the S&P 500 has posted an average gain of about 38%. Those gains were 54% in 2020 and 20% in 2022. Yes, we're in the midst of an economic slowdown that is expected to become an outright recession. However, signs indicate that the recession will be short and shallow. The anomalies of the COVID pandemic are largely behind us, and supply chain woes are getting resolved. Inflation is cooling, jobs growth remains strong but not too hot, and the Federal Reserve is sending signals that it's on the verge of a pause in its tightening cycle. Take a look at this chart. Investors are optimistic with U.S. and overseas stocks ending last week higher. The Dow Jones Industrial Average gained 0.3%, the S&P 500 gained 0.4%, the NASDAQ gained 0.1%, and the MSCI EAFE gained 0.4%. In good news for inflation fighters, the price of crude oil last week fell 2%. As you can see from this chart, despite additional production cuts announced on June 4 by OPEC+, oil prices have declined. It's a remarkable development that reflects the diminishing clout of the oil cartel. It also shows that energy traders are more concerned right now about demand rather than supply. Reports also are surfacing that Saudi Arabia, the de facto leader of the OPEC+ cartel, is feuding with its partner Russia. Apparently, Russia has been cheating on its quota because President Vladimir Putin desperately needs revenue to fuel his war machine in Ukraine. That's further good news for the West in its fight against inflation. It's also worth noting that the CBOE Volatility Index, the VIX, aka Fear Index, has been falling. When the VIX surpasses 20, you can expect greater than normal volatility over the next 30 days, and vice versa. The VIX has pulled back below the significant demarcation of 20 to hover below 14. That's a positive sign. A lower VIX means less fear and stress in the markets. Let's also consider the S&P 500's moving averages. A moving average, of course, smooths out price trends by filtering out the noise from random short-term price fluctuations. It's a clear bullish signal right now that the S&P 500 currently hovers well above its major moving averages, as you can see here. Now, let's take a look at the week ahead. This week's economic calendar features 3 important events: the U.S. Consumer Price Index Tuesday, and the U.S. Producer Price Index, and the Fed's interest rate decision Wednesday. The interest rate decision will be followed by a press conference by Fed Chair Jerome Powell. If the CPI and PPI reports show that the rate of inflation is continuing to decline, and the Fed stands pat on interest rates, and Jerome Powell doesn't talk down the markets, the new bull market is likely to pick up speed. I recommend that you stick to your strategic long-term allocation for the asset classes that comprise a well-diversified portfolio, including bonds, which currently offer historically attractive yields. Start increasing your exposure to your wish list of growth stocks that previously seemed too risky. I also suggest you consider the advice of my colleague, Robert Rapier. As chief investment strategist of Rapier's Income Accelerator, Robert has developed strategies that make money in bull or bear markets. Robert Rapier can show you how to squeeze up to 18 times more income out of dividend stocks with just a few minutes of work each week. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, that's it for now, and if you have any comments or feedback, please don't hesitate to send me an email at mailbag@investingdaily.com.